Hello, welcome. My name is Ronald. I'm with Indicator Vault, and we're going to go over in this webinar moving averages. And this is probably one of the most popular indicators you'll see used in the market. There's so many different ways to use them and to view them. There's multiple different types of moving averages, and they each have their own formulas and of how they calculate how they go on the chart. And so we're going to go over some examples here as far as a couple different ways to use them as extra confluence and confirmations for trades, and where we can see price going. So let's start here. I've got the euro to the British pound chart here, and I've got two moving averages. They are, see if I can pull it up as I hover over. I've got a 20 EMA and in here 40. And now the numbers necessarily aren't as important. There's nothing super special about any specific number. There's just different ways you can play around and with whatever type of moving averages you want. However, the 20 and 40 I've seen before as popular ones to use a crossover type of strategy or way to view the market. And what that means is, as we can watch where they cross, right? So here, the 40 is below. See some consolidation, some choppiness in the market. And then we see it cross in this area, right? Where now the 40 goes above it. It doesn't last for long as price then moves up and then tanks real hard. And now we see it again where the moving averages have crossed, where the 40 was below the 20, but now the 40 is above the 20. And so what we can gain from that is basically seeing where the trend is going. So as long as, with these two specific moving averages, and these are EMAs, these are exponential moving averages, is that as long as the 40 is above the 20, we can expect the trend to continue. And so far, once we see this cross, we can gauge that a change in a trend is coming. And we do. We see quite the sell-off for that bit of time, right? And the entire time the 40 is staying above. And we can look for different trade setups in here, and refine to smaller time frames to play off. And so as whatever other confluence or strategy you like to use. So then we see price come back up, and just a lot of choppiness, a lot of consolidation, and you can see the MAs cross, and there's not really much separation, not a whole lot of confluence until we get to about here. So, and this is where I would start to frame a trade setup. If I was looking at price in this overall area, I see some inefficiencies, some gaps up here that I believe price needs to rebalance to. I see these highs where buy stops are residing that price wants to take. And so as I see price come here and these three aggressive, very strong moves up in the market, and we see here right as the MAs cross again, that's to me now signaling, okay, now we're going to see some up movement from this pair. And so what are some ways we could frame a trade setup if we were to, incorporate the moving averages in our trading strategy? Well, like I said, lots of choppiness. We now see this strong impulse where it could be signaling to us, okay, price is starting to want to move back up to fill up the gaps, to the left side of the screen. Well, one of the most basic other confluences here. See this demand candle, forms this last down close candle before price breaks above the high that created the low. And not only do we see the MAs cross, but another popular way of viewing moving averages is playing off of the bounces or the touches of the moving averages. And so as we look at this confluence, look at perfectly touches the top of the demand zone while, only spending a couple minutes below the average as well. And so a perfect touch of the zone and off of the moving average, 12 pips be a stop below the POI. Of course, it moves well over 100 pips. Not that you would necessarily hold for all of that, but let's say you just held to just this next high, just to create a new and take out the most recent intermediate high. That's over a 5-to-1 trade right there. 5-to-1 R&R. And again, using the confluence of we've now switched over, the MAs have now crossed, signaling a change in trend is coming. And so when looking at the confluences of that, along with this demand zone that formed, along with a touch, and also with a fib. Right at the 61.8, barely touches it. And so numerous confluences here. And in some other examples, I'm going to go over where touches, just bouncing off of the MAs is for me personally, I love using that as confluences. You can get used to viewing certain MAs and how price likes to play off of them. You can play off of the bounces, and obviously we see this one was quite an aggressive one, but look at all the confluences we have with the crosses, the demand zone, and the fib. So an incredible trade to be had there. And we can see, price now has crossed back over and going into probably some more consolidation, maybe similar to over here. And we'd have to wait for price to kind of signal, does this trend want to continue down more, where the 40 is going to stay above the 20 for another, leg down. Or maybe it wants to cross over again and come back and create another higher high. We'll have to wait and see. Let's move on to another example. I believe here in the euro. Yeah. So on this chart, I've put on here a 200 EMA. 200 is probably one of the most popular moving averages. It is very much considered a trend following moving average, where if you just have that alone on your chart, you can gauge if price is above it and it's, moving higher and higher. As long as it stays above the moving average, you can look for more buys to continue the uptrend, and vice versa. As we can see here, once price, did break above it, came back down, didn't do much, touches here and just continues to fall as the moving average stays above the price. So this is actually more or less my preferred way of using moving averages, is playing off of the bounces, and you can get really precise entries doing so. And so let's zoom in. All right, so again, we've got the euro hourly chart. We can see price shot up. Didn't really give us much, confirmation that it, wanted to continue up. As it came down, it didn't, no clean touches on the moving average. Lots of consolidation through here until we get to this area. Now, if we look here, I can see here just a touch below, just taps it, maybe just a pip or two above it, stays below it. And we can see, look at these three candles. None of these three closes above it. So when I see that, I'm now looking for price to respect this moving average and not want to go above it. To me, that is signaling this is the start of it, forming a downtrend. The quick touch here and pulls away. Few hours go by. Yeah, it pokes above it. But once I see, these three candles respecting this so precisely, and then these three, strong moves down, that is now signaling to me, okay, this was a fake out. It's actually wanting to respect this downtrend coming in respect to the 200 moving average. And so let's add a couple other confluences. There's no one right way to draw a demand zone. Sometimes I would maybe use this entire range. Sometimes it's the most recent candle. I use this most recent candle because if you see here, that white dot of this rectangle represents the 50% mark of this zone, from the high to the low of this purple box. That is a 50% mark. You can see this, how price perfectly touches it. And that's normally going to be your most sensitive price point of your supply and demand candles that you mark out, is the equilibrium of that range. If we put a fib on, it does go well above the 70.5. However, with such a quick pullback, this candle is mostly wick and not body. With such a quick pullback, again, that's confirming even more that it's wanting to move downwards. And so, but let's say you want it, even if you got in a trade here, just a 14 pip stop, just to create a new lower low, that's almost 50 pips. That's a great trade alone. However, I probably would have been looking to have it continue down because, again, signaling is going to respect in a sense, a new trend down. We're catching the start of this new trend right at the beginning. We don't have to just look at this low. We can look at other lows. So even just from the bottom of the supply zone to this low over here, 78 pips. And so, but let's say you wanted to wait for even more confirmation, right? So, we got the confirmation with these candles. Another confirmation is wanting to push away from this zone with that long wick. Touches 50% mark of the supply zone, just taps above the exponential moving average. Well, this whole pattern here that I marked out is going to repeat itself. Another supply candle that breaks below the low that created the high. Price perfectly touches it right here. And again, for some other confluence, while it doesn't quite get to the 61.8, We can see it does reach into the premium discount of the range. You just put an entry at the bottom of the zone. You know, you're looking at a 10 pip, 11 pip stop just to have it above the zone. So again, numerous confirmations just from looking at a 200 EMA that price is wanting to start its way down. And obviously we can see it has, you know, been quite the downtrend. And of course, as we, you know, price starts to move down, we look at this, okay, now we're getting some candles closing above it. Comes back down, doesn't really break these lows. Comes back up, it does close, not as much as over here, but it does close above it some. And so what this is telling me is the sensitivity for this downtrend is now over. We're not really going to see the, you know, we got the beginning of the trend here with, you know, extreme sensitivity to the moving average. And so now as we start to see some of this, we've got to wait for more confluence, for more confirmations to add up, you know, as far as getting in some, you know, trades. Not that you can't use it for confirmation, but just the extreme sensitivity that we saw over here, we're not going to quite see yet, right? We've got to wait for price to show its hand again in regards to the moving average. Now, one thing to note, though, is if you take all of this range here, look at how much is below the moving average, right? The vast majority of price action is still taking place below the moving average. And so we can still frame some sell setups just based off of that, right? You know, we can see, yeah, some candles close above it. We can see some sensitivity here. This candle barely, you know, it just opens and then drops. All these wicks where these candles don't close, right? So we use these, you know, like I said, you have to get an eye for a lot of this, but it's a great way to, you know, use for trend trading. And if you catch it at the start of a trend with some touches, you know, it can be extremely powerful, you know, because as we see, as it starts to close above it, we do have one more drop down. But then look, now we've started a new uptrend. And while we don't, with trading, you've got to be versatile. So while we, you know, we get a touch here, goes below it, hangs below it for a little bit, breaks above. This is where, you know, in just like the Euro British pound example, if we are thinking there could be a change in direction, which we can start to think that based off of some of this, like, okay, it's kind of wanting to reach over there. There's still some sensitivity to it, but it's losing its effectiveness. We now see another strong close above it, another strong close above it. Not just a strong close above it, but above what? These highs here, right? So as you know, the EMA starts to level out, find the demand candle that broke the most previous high. Right there. Price moves up, breaks this high to validate this supply area. Again and again, since we're now looking for bullishness. It's above the EMA. So now touch the supply area. Excuse me, demand zone. So let's say you entered, it's not much. If a classic way to use a fib would be from this low to this high, and we can see it does go into discount of the range. However, you can also use it from just your supply or demand zone, right? Look how it never closes below the 70.5. You can use, you can be versatile with your fibs as well in confluence, so we've got a number of things. The demand area, the bullishness we're expecting because it's above the EMA now, and a fib anchored from the demand zone. So just with a 27 pip stop below the zone to create a new high, 67 pips. It's not bad, but we can look further to some other highs, right? So if it wants to take out this high, it more than likely also wants to take out this high, which is over 100 pips away. And obviously we can see it's gone well beyond that. All right, so let's move on to the last example. I believe I have with UJ here. I'll put that fib back on in a minute. So this is where you can kind of play around with some numbers to put on your charts as far as moving averages. I've got the 89 and the 55, the smoothed moving averages. Now, these numbers, 55 and 89, are part of the Fibonacci sequence, right? If you're familiar with that, believe it, you look up the Fibonacci sequence and you will see, I believe, 34, 21, 13, those are also numbers, 8, 5. I don't really use the smaller ones, but I just wanted to show, you can use these, as crosses as well to help with trends. You can use these as touches as well. You can see the sensitivity here. A lot of times you'll find they'll even line up with fib ratios. For instance, I believe I had this here. We've got this price range. We've got this high and this low. We've also got this supply area. Perfectly touches the bottom of it. Perfectly taps off the 55 SMA. Touches the 61.8, just about gets to the 70.5. So again, just adding confluence to getting into trades. Prices trading below it. Look for other confirmations. We see the cross. We see the higher, the 89, now over the 55. So it's telling us, okay, there could be a change in direction or a continuation of this trend. Find some other detailed confirmations. We can see some sensitivity to this one. And now we see the, perfect sensitivity to that one for the first impulsive leg was 130 pips. And so, play around with different numbers of the moving averages with the different types. I wanted to bring up these Fibonacci numbers because they, you can just start to get an eye for them and how price will react. Again, there's nothing super special about the specific number, but there are, specific strategies you can use for different numbers and what to expect from them, right? So you can go even more, the next, find the next Fibonacci number. You can use that. An actual Fibonacci ratio, the most popular number, like I've said, is 61.8. So you can put a 62 moving average in and see how price, moves around on that. You'll find a lot of times, actually, these will even line up, with the actual, Fibonacci numbers. You can use a confluence of, as you got the 62 moving average, and you can have a trading strategy just from it touching the 62 moving average and the 62 retracement. You can add 70.5. I see a lot of others also like the 78 or 88, which lines up with the 89 moving average. That can be a trading strategy all in itself. And so before I go, let me just show some of the different ones. And these aren't necessarily all of the moving averages. But these are the ones that will come on your MT4. You've got the simple, which it just takes, the last, whatever period you're looking for. It just takes the, average price of the close or the open or the high low. You can have all these other different types here and just puts it together. The exponential and the smoothed have other formulas. The linear weighted one, one I actually like to use is another Fibonacci number of 144 of linear weighted. Let's see how that changed. See the sensitivity that it plays off of. The perfect touch here. Actually, this high. See, price never closed below the 70.5. Perfectly touches that. And again, I've traded with 7 or 8 different moving averages on my charts before, looking how price plays in between them. You can use it to identify when price is wanting to consolidate or when it's wanting to move in a trend. You can use the crosses. Some of the lower numbers will, as far as like maybe a 8 or a 13 can, they'll stay close to price a lot. But when you get like these strong impulsive moves and then a little bit of retracement, these 8 and 13s will catch up to it soon, and you'll get other perfect touches to, capture the continuation down. Of course, we see, some touches here. And just simple confluences. You can draw up some supply zones, and if you don't get it, seeing that this one, it has a leg down. You got some fib confirmation, but it doesn't touch an MA and it doesn't touch the supply zone. And so, you need to figure out for your trading strategy if that's a trade you want it to take. So this is, again, one of the ways you can use moving averages. Even you can go up to an 800 moving average. You can do more. 800 will tell you even bigger trends, right? Because it's taking into account much larger number of candles. And you can have different moving averages on your screen. You can have the linear weighted. You can have the smoothed, the exponential. Let's say, the default setting is to have it to the close. Let's say you just had it, the high, the median price factored in, which is the high and the low, the middle point of that. See, it didn't change much, but it did change. Let's show this one. So your weighted close, the divided by 4. Let's do an open. A little bit of change. So again, get an eye for the moving averages. They are extremely powerful. If you catch the trend, they are going to show extreme sensitivity to some of them. You couple it with just, some other basic confirmations. You can incorporate these into a strong trading strategy. Whether it's crosses or even just the touches, the bounces from the actual MAs. So thank you for your time. I hope this video helped you understand the moving averages a little bit more. And until next time, best of luck trading.